Our second video from Chapter 7 continues with our discussion of tax-free reorganizations. Now we're going to look at types D, E, F, and G. The type E is a transfer of assets to a controlled corporation. So it's a transfer by a corporation of all or part of its assets to a corporation controlled by the transferor or its shareholders. You may remember that we said that you can use a type D essentially as a merger technique or as a way to split up one corporation into several parts. The acquisitive type D, where we're merging two corporations, works like this. The acquiring corporation is going to transfer all of its assets to the target. Seems like the target's acquiring the acquiring corporation. But it's not going to work out that way, because what the acquirer is going to get in exchange for its assets is the target corporation stock. And the newly issued target corporation stock will give the acquiring corporation a majority of the shares. Control in this case means more than 50% stock. So we're not using the typical 80% that we usually mean when we're talking about control in a tax situation. Assets to a corporation controlled by the transferor means more than 50%. The acquirer will then liquidate after having transferred all of its assets and distribute the target stock to its stockholders, and it'll work out that its stockholders will then have a majority of the shares. That's why we call the acquirer, even though it's the one liquidating and transferring its assets. So here's the acquisitive type D. We've got A and P. A is going to transfer its assets to T for newly issued T shares, but they will be sufficient number of new shares that'll give A control. And then A liquidates, distributes the T stock to its stockholders. Now its stockholders have control of the combined corporation. So it really is A acquiring T, even though it looks a little bit upside down. A divisive type D, where we're taking a corporation and dividing it up somehow, the original corporation will transfer a portion of its assets to one or more newly formed subsidiaries. So there we have the transfer of all or part. If it's all, well, you may be looking at an acquisitive D, although we'll see in a minute that's not always true. But if it's a portion, then definitely we're talking about a divisive D, where we are taking one corporation and dividing it up somehow. Transfer a portion of the assets to one or more newly formed subsidiaries in exchange for the stock of the subsidiaries. Then what do we do with that stock? We can transfer the subsidiary shares to our stockholders, some or all of the stockholders. If we do it pro rata to all of the stockholders, like a dividend, that's called a spin-off. To me, the most famous spin-off that I remember is when the old AT&T, the old Ma Bell, the old phone company predating the advent of cell phones, divided up its local phone service to about 6 or 8 newly formed subsidiaries. It was part of an agreement with the Justice Department. They thought AT&T was too much of a monopoly. And so they spun off the local phone service companies to 8 different regional firms, or whatever the number was. That's a spinoff. Every shareholder of AT&T received stock in the baby bells, as they called them, in proportion to their ownership of the original AT&T. Or you can send the shares to some stockholders in exchange for their shares, like a redemption. That's called a split off. You take a company and you say, okay, everybody who's working on the west side, every stockholder who's more interested in the west side business we will exchange the shares in the combined company for shares in the new West Side Corporation, and all the shareholders interested in the East Side portion of the business will just keep their old shares in the original company, but the original company won't have its West Side business anymore. So you take a bunch of stockholders and you just divide them up. Some people get the West Side, some people get the East Side, and you go your separate ways at that point. That's called a split off. You split the West Side off from the East Side, and everybody goes their separate ways. You can also have the original corporation transfer all of its assets to two or more newly formed subsidiaries in exchange for the stock of those subsidiaries. So now the original corporation is just a holding company with those two subsidiaries as the companies that it's holding. And then it says, all right, now we're going to take the stock of the subsidiaries and we're going to transfer them to the stockholders. And now you can do it in a lot of different ways. You can do it like a split off where you say one group gets the West Side, the other group gets the East Side, and nobody gets anything in common. Or you could do it like a spin off. Everybody gets the same proportion of all of the subsidiaries. And then if you want to buy and sell afterwards, you can change the ownership interest, but you're going to start out with everybody having exactly the same proportion. That would be very much like a spin-off, or anywhere in between. So you have a lot of freedom with this form of the divisive type D. So you could have some people with 90% West Side, 10% East Side, and other people with 90% East Side, 10% West Side. You could work it out a lot of different ways. You have a lot of freedom here. Whatever proportion the stockholders agree on. And it is now like a liquidation. So we are taking the original corporation and basically liquidating it, but we're liquidating it into some newly formed subsidiaries in exchange for the stock of the subsidiaries. And it's a tax-free transaction, whereas a liquidation is, of course, taxable. This is called a split up. And again, you've got the most freedom to choose how you want to do things with the split up. So you could effectively duplicate what goes on with a spin-off or a split off by doing the split up. The requirements of a divisive type D. So if you're going to do any kind of a divisive type D of the three types that we mentioned, the original corporation must transfer a controlling interest. Now we're back to the 80% or more. Controlling interest of the new subsidiary stock to its stockholders. Probably would be 100%, but it's got to be 80% or more for sure. If it's a spin-off or a split-off, the original corporation and each of the subsidiary must operate a business that has been owned at least 5 years. If it's a split-up, then each of the subsidiaries must operate a business that has been owned at least 5 years. So the split up, obviously, the original corporation is not going to own anything anymore. It's effectively liquidating. But in all of them, you've got to have the different corporations involved that are surviving at the end of the thing with a business or one or more businesses that have been owned at least 5 years. What's going on there is they don't want you to go out and just buy a gold mine and then say, we're doing a split off and we're going to split off that gold mine that we just bought 2 weeks ago and essentially bail out earnings and profits by converting our excess cash into a gold mine and then splitting off the gold mine. No, you can't do that. That's why that 5-year rule is there. You want to hold that gold mine and mine gold for 5 years? Fine, that's okay. But just to buy something like that, just to convert cash into this other asset and then split off the other asset, no, that's not allowed. In all cases, the transferor must have owned the controlled corporation or its businesses for at least 5 years. So again, it's got to be the transferor corporation in all cases, owning the business for 5 years, didn't just go out and buy it last week to turn cash into this business and then turn it back into essentially cash. Reorganization cannot be a device for distributing earnings and profits. So we've blocked the ones that we can think of. If there's other ones that you come up with that we haven't thought of, we'll use this provision to say, no, that's a device to distribute earnings and profits. It's very clever. We never thought of it, but no, you can't do it. Continuing with the tax consequences, the transferor corporation, no gain or loss is recognized unless boot is received and not distributed. Very unlikely that's going to happen. Generally, the transferor is transferring shares of the new corporations that it has just formed and transferred its assets into, and it's not going to be receiving boot from anybody. So it's very unusual that there would be boot received and at all, let alone received and not distributed. But of course, it's possible that you could structure some strange transaction where that happens. If it does, you might have to recognize gain up to fair market value of boot received. But it's going to be very unusual. So generally, you would think no gain or loss recognized by the transferor corporation. Liabilities discharged, they are boot, but they will not trigger recognition of gain unless they are greater than the basis of the assets transferred. Again, hopefully that's not likely to be the case, but it could be. The basis of the stock received is equal to the basis of the assets distributed minus fair market value of boot received plus gain recognized. And as we all know, those two adjustments frequently equal and offset each other. For the stockholders, no gain or loss is recognized unless boot is received, and the basis of the stock received is the basis of the old stock. If you do a spin-off like the old AT&T, you've got to have to prorate the basis of the old stock to the original corporation and to the one or more new corporations, and that would be done based on the fair market value of all of those shares. AT&T had to issue an advisory to its stockholders saying the basis of each of your stocks is equal to whatever percentage they had for each of the subsidiaries and the old AT&T, and they said it should add up to 100%. So take the basis of your old AT&T stock and divide it up among the Baby Bells and the original AT&T in the following percentages, and they gave you a list. So that's how you do it. You got to figure out the fair market value of the new shares and the old shares after the division takes place. And again, subtract out fair market value of boot received, and you know what's coming next. Add the gain recognized. Type E is a recapitalization. Now we are going to start the day with one corporation, end the day with one corporation, the same corporation, and we're going to change something about its capital structure, but we are not merging, we are not splitting up, we are just adjusting the capital of a single corporation. So this is an exchange of stock or securities of a corporation for other stock or securities of the same corporation. We're just swapping some kind of securities for other securities inside the same corporation. We're readjusting the capital structure of this corporation. So you might issue common stock to retire other common stock. Maybe you've got multiple classes of common stock and you really only want one. And so you say, let's retire all these Class B common shares, and then the Class A common shares will just be the common stock from now on. I'm going to just simplify things that way. So you issue more common stock A to retire the common stock B in order to get rid of the common stock B, and you just have one class of common from there on. That would be the typical sort of thing you might do with common issued to retire other common. This will qualify. Common stock issued to retire preferred stock also qualifies. There's just a small caveat, and that is, of course, you might have unpaid preferred dividends in arrears, and some of the stock that you're issuing might not be actually for the preferred shares, but as payment for the dividends in arrears. If that's the case, that stock that is received for dividends in arrears as opposed to received for the preferred stock itself, the stock received for dividends in arrears is dividend income at its fair market value. Okay, that makes sense. Generally speaking, though, common stock issued to retire preferred will qualify as a Type E recapitalization. Preferred stock issued to retire common stock. Well, that also qualifies, but then the preferred stock is going to be Section 306 stock, and we already saw that Section 306 stock is not a fun thing to have. It is, you can't sell it. You sell it, and it turns into essentially dividend income, except you don't get to reduce earnings and profits. So it's not fun. Section 306 is essentially considered a punitive section, and if you've got 306 stock, that means the Internal Revenue Code is punishing you for having that stock. So yes, you can issue preferred to retire common. It will qualify as a Type E recapitalization, but you're going to be left with something that you probably don't like. Bonds issued to retire other bonds. Well, that qualifies as long as you're just swapping bonds for other bonds. If the bondholder receives bonds with a face value greater than the face value of the bonds surrendered, the fair market value of those excess bonds received is boot. So you issued some bonds some years ago, and now they are selling at a big premium because the interest rate has dropped, let's say, from the time you issued until now. So the bonds are selling at a big premium, and you'd rather get something closer to par, so you swap out those bonds for other bonds. Well, you're going to have to give more par value bonds to the bondholders in exchange for their premium bonds. And so the fair market value of that excess is going to be treated as boot, and they're going to have to recognize gain up to fair market value of boot received. Otherwise, bonds issued to retire bonds are fine. Stock issued to retire bonds. That will qualify as long as you're issuing stock to retire the bonds. If you are also issuing stock to take care of unpaid interest, then the receipt of that stock is going to be treated as interest income. That's not going to be part of the Type E recapitalization, which is tax-free. Same as with the preferred dividends, that the stock received for preferred dividends is dividend income. Stock received for unpaid interest is interest income. But stock received for the underlying securities is tax-free as a Type E recapitalization. Bonds issued to retire stock. No way. Does not qualify. That would be an opportunity to bail out earnings and profit. You've got stock with a bunch of earnings and profits. You don't want to declare a dividend. And so you say, let's do a Type E recapitalization. We'll convert those stock into bonds. And then, of course, the bonds will eventually mature and you'll pay them with your excess cash. They say, no, sorry, that does not qualify. You're not going to bail out your earnings and profits by converting your stock into bonds. So some of these qualify, some of them don't. Some of them are a bad idea because you wind up with tainted stock. How do you remember what to do here? Here's a handy trick. Remember that bonds are the most senior securities. Common stock is the most junior, and preferred comes in between. The senior status of bonds is that they are senior in the case of liquidation. The bondholders get paid first, preferred stockholders next, and the common stockholders are last in line. So they're the most junior security. Okay. So bonds are senior, common stock is junior, and preferred stock is in between. Okay. Just We all know that. Okay, so keep that in mind and then say if junior securities are issued to retire senior securities, that's fine. When you retire the seniors and replace them with juniors, that's normal. And the older I get, the less normal that feels. But it is. It's normal for seniors to retire someday and juniors to replace them. And so if you retire the senior securities like bonds and preferred stock, replace the bonds with preferred or common stock, replace the preferred stock with common, that's fine. It qualifies, and at most you're going to maybe have some dividend or interest income for the portion of the junior securities issued to pay for dividends in arrears or unpaid interest. Otherwise, it qualifies as a Type E, no problem. When you turn it around and the senior securities are issued to retire the junior securities, so now the juniors are retiring and the seniors are replacing them, that's upside down and backwards and weird. And it's either disqualified or it gives you Section 306 stock, which is no fun. So that's kind of just a little memory trick. The meaning of senior and junior in the case of stocks and bonds is not the same as the meaning of senior and junior when you're talking about human beings. But if you keep in mind that juniors retiring seniors is normal and seniors retiring juniors is not, then that will help you remember which things work as a Type B reorganization when which ones either don't qualify at all or create 306 stock, which is not a good idea. All right. Type F. I love the Type F. Type F is so clean. Doesn't have any of these weird complications that we run into with A, B, C, and D, and E. It's a change in identity, form, or place of incorporation. For me, I think the most common that I think of it is when you want to change your state of incorporation. So, a corporation A is incorporated in New York State. Paperwork is filed in Albany, but they've decided they want to become a Delaware corporation. When you hit it big, you want to move to Delaware. All the big Fortune 500 companies, or a vast majority of them anyway, are Delaware corporations. There's a lot of advantages for a very large publicly traded corporation to be incorporated in Delaware. So let's say, okay, we hit the big time. Let's move our state of incorporation to Delaware. Now, we're not going to move our stores. We're not going to move anything else. We're just going to become a Delaware corporation. So it's just the state of incorporation. That's all that matters. That's all we're changing. But you can't just call up Albany and say, hey, transfer that paperwork over to Dover. Albany will tell you, no, we don't do that. So forget it. It's not happening. So what do? How does a New York corporation become a Delaware corporation? Well, what you do is you correspond to Dover and you form a new subsidiary down in Delaware. And so now you've got this new subsidiary, which is a Delaware corporation, wholly owned by your New York corporation. Then A will transfer all of its assets and liabilities to the new subsidiary, the new Delaware corporation. And in exchange, it will receive all of the subsidiary stock, which it then will distribute to its shareholders and liquidate. The New York corporation now is no more. It has no assets. It's gone. And they'll probably write back to Albany and say, the New York corporation has liquidated. Please remove it from your rolls. It no longer exists. And then all of the subsidiary stock is transferred to the stockholders, and they now have shares in the new Delaware corporation. Usually it's a 1-for-1. Why make it anything other than 1-for-1? So just one share of the new Delaware corporation is equal to one share of the old New York corporation. And you are now a Delaware corporation. And it's nice and clean and easy. You can do it in the middle of the year. Doesn't matter. You don't have to wait till the year end. When you file your tax return at the end of the year, you will file it for the entire year as if there was no change, even though the corporation that existed at the beginning of the year is absolutely different from the corporation that finished the year. For tax purposes, it's all treated as the same corporation. You don't even change the tax ID number. Everything carries over from the old one to the new one, even though it's technically a completely different entity. That's what I love about the F. It's just so clean. So you just do it. Now you probably have to do a shareholder vote to say, yes, you can do that. Otherwise, you just do it. And it's cheap. Most corporations actually did a little study of this for one of the research projects I worked on several years ago. One of the things we want to know is how much does it cost to do it? And in most cases, large corporations didn't even disclose the cost. It was too trivial to mention. Where corporations did disclose the cost, it tended to be a few $1,000s. So you're talking about a multi-million or multi-billion-dollar corporation had to spend a few $1,000s to change its state of incorporation. It was trivial. And as I say, most corporations didn't even bother disclosing the cost. Those that did, it was tiny as a fraction of the value of their shares. Problem number 36. This is interesting. Beach Corporation, a seaside restaurant, is owned by 20 unrelated shareholders. This year, Beach made the national news for polluting the surrounding beach and ocean with garbage. It was fined $200,000. Beach fired its chief executive and appointed a new board of directors. The new president, Sandy Shores, vowed to clean up Beach's pollution and become more socially responsible. To put this damaging episode behind them, the board of directors wants to change Beach's name to Protected Bay. So it'll no longer be Beach Corporation, now it'll be Protected Bay. Further, it would like to change from a C corporation to an S corporation to make the owners feel more responsible for the business. Explain how these corporate changes can be accomplished and what the federal income tax implications are for Beach. Well, I believe it is the case that you cannot simply change the name of your corporation. You incorporate as Beach Corporation, then the paperwork in the state where you incorporated says this corporation shall be heretofore known as Beach Corporation. And the way to change it to Protected Bay is to form a new corporation called Protected Bay and do a Type F. So the name change qualifies as a Type F reorganization because you actually do have to create a new corporation with the new name and then transfer all the assets from the old corporation to the new one, just like you do with a change in state of incorporation. So that is definitely a Type F reorganization. The election to change from a C Corp to an S Corp is also, according to the textbook, this surprised me. I never knew this until I did this problem. That's also apparently a Type F reorganization. I never thought of it that way. Now there you're not reincorporating at all. You don't have to alert the state that this corporation is no longer a C corporation, it's now an S corporation. In New York State, actually, if you want your C corporation to be treated as an S corporation for federal and state purposes, then you have to file the proper paperwork with both the IRS and the New York State Department of Taxation and Finance. But you're not changing the corporation. The identity of the corporation stays the same. So I don't know why the textbook said that's an F reorganization, but they do say that. So I don't know. Okay. Anyway, definitely the name change is, maybe this C to an S also is. I'll accept it unless and until I find out differently. F reorganization, the successor corporation inherits absolutely every tax attribute of the original corporation without restriction, as I say, all the way down to the tax ID number, as well as earnings and profits, net operating and capital loss carryovers, accounting methods, everything. It all just carries over without interruption at all. The consequences of the S election we will cover in Chapter 11, but we're not going to go into that now. We have an entire chapter on S corporations. Chapter 11, we will get there. We're still on Chapter 7, but we'll get there toward the end of the semester. Type G, the final type, is the insolvency reorganization. And here, this could take the form of an acquisitive type G or a divisive type G or a recharacterization within a particular corporation. So you could have, it could be almost like an E, a recapitalization. Could be any of those. Is the transfer by a corporation of all or part of its assets to another corporation in a Title 11 or similar case. So you could form a brand new corporation, transfer everything to the new corporation, but divide up the stock among not just the old stockholders, but also the old debt holders in some way. That would be a recapitalization, very similar to a Type E. But you could also have the corporation taken over by another corporation, which has deeper pockets and so therefore can absorb the corporation's debts, delete the money-losing businesses, and salvage the profitable portions, things like that. So lots of different ways you can do this with a Type G. Here's an example. Corporation T is insolvent. It's in Chapter 11 bankruptcy. And so they find Corporation A, which is willing to take over. They say there's value in Corporation T. It shouldn't just disappear. And so we'll help out. Transfer all of your assets to Corporation A in exchange for some A stock. Now T has A stock, and now it's going to liquidate and distribute the A stock to its creditors or some subset of creditors. And then the other creditors, I guess, would become creditors of A. Okay, so that would be a possibility. And of course, you'd have to get the approval of the creditors and the bankruptcy judge and all those folks. But that's one way to do it. And bankruptcy courts are very keen to find someone like Corporation A that would be willing to salvage the value part of the business. The creditors also very happy to do that, much prefer doing that than just having a fire sale and getting pennies on the dollar back from the corporation. So yeah, everybody's happier if you can do something like this as opposed to just letting T completely disappear and selling off the assets and just paying off the creditors what little you can get for the assets. Everybody's better off if you can keep the thing as a going concern, as long as it doesn't just keep losing money. Requirements of a Type G: the stock or securities of the acquirer must be distributed. So the acquirer can't just acquire these assets and then just transfer the stock back to Corporation T, which just holds on to them. No, they have to be distributed. For continuity of interest purposes, however, the creditors will count as owners. They effectively are. If the corporation is insolvent, the creditors have essentially become stockholders, whether they like it or not. So they're going to become stockholders of A instead of stockholders of T. The stockholders of T aren't going to get very much. And it might be that the creditors are the only ones who get anything. The stockholders might not get anything. Or they might get a share. But the creditors will also get a share, which is why they'll agree to this deal. Topic of cancellation of debt and insolvency. This is not 100% related to the Type G reorganization because sometimes you can deal with an insolvency without doing a Type G. There's other ways that you can deal with insolvency. But if you do have cancellation of debt in insolvency, in a Type G or otherwise, then these are the rules. No income is recognized because of the cancellation of debt. Instead, reduce tax attributes, starting with any net operating loss carryover, Then we'll go to regular tax credit carryovers, then capital loss carryovers, and finally, once you've run out of carryovers, the basis of assets will be reduced. That is it for the second video. So we did D, E, F, and G, and a little bit on the cancellation of debt. The next video, the final video from Chapter 7, is going to be on corporate attributes and what happens to them in a reorganization. We know what happens to them in a Type F, nothing. But what about the other ones? And we're going to talk about inheriting another corporation's attributes or not, and exactly what the rules are for that. That is our final video.